The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances. And with that, let's get to this week's episode.
Hi, I'm Jason Nickerson, President and COO, and this is Financial Focus. Here in this episode, we're going to talk about one of the big I words that is prevalent in the news right now, and that's interest rates. There's another I word, inflation. These two seemingly are going together right now, especially this past week when Fed Chairman Powell was on Capitol Hill testifying in front of Congress about inflation and his use of rising interest rates to quell inflation. What we're going to talk about today is how you can take advantage of these higher interest rates, because you may be seeing in your bank account, and especially in your bank savings account, that interest rates have not gone up along with other rates in the economy. And so how do we get those better rates? Well, first we need to understand why banks may not be increasing rates on savings accounts right now, and that is banks are a business. Just like anybody else, they need to make money. How they make their money is by the rates that they charge on loans, but also by not paying out as much interest on the savings or the deposits that they have in-house. And their interest rates are determined by those things. How much are they charging on loans, and how much are they paying, and do they need to attract more deposits into the bank? If they don't need to be attracting deposits to support loans or other operations, then they will not increase those rates. So where can we find better rates? Well, right now, what we're seeing is that bigger banks are not increasing their rates as much, maybe, again, because they don't need to attract those deposits. And what we're finding is maybe smaller banks and credit unions may be offering more attractive rates. As a matter of fact, as published on bankrate.com, a very commonly and well-known information website on loan rates, bank rates, etc., published on March 2nd, 2023, that the average savings account rate was 0.23%. So you may be experiencing this, but what we're seeing is that maybe some of your smaller banks and local credit unions may be offering more because they need to attract those deposits to support loans. One other area you could check out is online savings accounts. Now these, you want these to be FDIC insured, so that would be some research that would need to be done, but there are four that we tend to like. Marcus by Goldman Sachs, Amex, American Express, Ally, and Capital One. The rates range from about 3.5% to 3.75% from what we're seeing. And if you're comfortable doing online banking with your normal bank, you might be comfortable with these banks as well. And the ones I mentioned are FDIC insured. Now, how they operate is a little bit different than your normal bank. With your normal bank, you can use an ATM. You can walk into a brick and mortar building and withdraw money. With online savings accounts, you cannot do that. These are all connected to your current checking account. So you go into their website and open your account and establish a link to your current checking account. Anytime you want to put money into the online savings, you go into their website and tell them to pull it from your checking account. And anytime you want to take money out, you go into their website and you tell them to deposit back in your checking account. Those transactions could take 2 to 3 days. So you just need to be aware of that if you need this money in the next hour or 2 hours, it is not immediately accessible. But this is how they get to pay higher rates. Something else you may want to consider is if you don't need immediate access to these savings, there's a lot of great CD specials that we're finding out there. And again, you want to be careful because CDs are typically locked up for a period of time, and it's not that you can't get the money out, it's just you're going to give back some of the interest that you earned. Other terms you want to pay attention to is jumbo CDs versus non-jumbo CDs. Banks would be offering more interest, higher interest rates for jumbo CDs, which could be up to $100,000 of initial deposit before you reach those levels. Also watch out for banks that are advertising great rates on what's called new money. This would mean that you'd have to be bringing new dollars into the bank in order to capture those rates. With interest rates these days, you don't need to be extending these terms out 3, 4, 5, 10 years. We're finding great rates and would advise staying short term, say around 12 months, give or take. And what we do, and we're working with clients to set up CDs, we tell them to set up CD ladders. This is simply going into the bank and buying, say, a 3-month, 6-month, 9-month, and 12-month CD, splitting up your total deposit into 4 CDs. That way, every 3 months, you have a CD coming due where you can access money, and then you just roll the rest of it over for 1 year, keeping your ladder moving every 3 months with maturities. Another place to look right now is U.S. Treasuries. Very safe place to deposit money, but again, consider this locked up money, not immediately accessible. What we're finding, based on rates published on March 2nd, is that all terms of U.S. Treasuries from 1 month all the way out to 30 years were yielding 4%. Now that's going to move on a day-to-day basis, so you just have to keep an eye on that. But these are a bit longer term compared to what you would find in the bank. And with that, that's this week's episode of Financial Focus. Thanks, and we'll see you next week.